So hi everyone. If you look at the markets, they have already moved up from the lower levels, but broadly we are range bound. Still, in the last 1.5 years, Nifty has been, hovering around 17,000, 17,500 levels, and still we are there only. Now the thing is, there are few things which are coming, positive from the international market, because for the last 6-7 months continuously, there were a lot of macro headwinds. Still headwinds are there, but at least there is some light out of the tunnel that possibly we can focus now in today's discussion. So if you see the highlights of today's discussion, broadly 3 major points: the performance of emerging markets vis-a-vis India. In fact, the performance of developed markets also we have shown vis-a-vis India, how it is panning out in the recovery market, in the falling market, both in the last few quarters. Second is, if you look at the US inflation, we have seen signs of, tapering off in the US inflation. So broadly, there are few points. People generally discuss about 1970s market. That particular decade actually had a muted performance from equities, but we need to, dig more and see if something is helpful to us from that data point. That is what we have done today. US yield curve has got inverted. That has been there for the last few months, but that invertedness is getting lower. The unfilled vacancies in US, because the people were not coming for jobs, that was very elevated. That has shown sign of topping out. Commodities, which declined, still that decline is persisting because of the dollar appreciation or because of the recession fears. Market is factoring another 1% rate hike in the coming 3 Fed meetings, actually in the remaining part of calendar 2022. When I look at from the domestic front, there are few positives like banks' credit growth, which has continued to grow to 15%. The 8 core industries data indicates buoyancy in Indian markets. It has been one of the highest percentage which we saw just last month in the Indian markets. Monsoon has remained above 8%, above the long period average, which has actually comforted the rural sentiments to some extent, which was under pressure because of higher inflation. There is a higher probability of India weight increase in MSCI going forward. So whenever the FII flow will revert, you will see the positives actually because of that. Lastly, the festival season, we all waited for that. Last 2 years, we could not enjoy. So obviously more expenditure may come out and corporates in India may have a higher top line. So this is what the discussion is going to be today. Let us have a brief discussion now on all of these points with some important data points. So when we look at the emerging markets at the start of February, March 2021, that was a time when the emerging markets peaked out, and that was a time when FI outflows started. You can see here that in that period, the FI outflows started even in the Indian markets. So obviously that top out scenario in emerging market had an impact on Indian markets also from the FII flows perspective. And that was a time when Nifty was somewhere around 15,000. From there, it moved to 18 plus. And since then, it has been hovering in a range of 15,000 to 18,000. It may take more time because technically it is forming lower top, lower bottom scenario. Last top of 18,200 was not taken out. So it is again spending more time here. But eventually, what we believe, because there has been an outperformance of Nifty over the emerging markets, they have come down, but Nifty has remained broadly here. So it is very much possible eventually the breakout on the higher side going to be seen in the Indian markets. Yes, it can take more time in giving that decisive breakout. So outperformance of India vis-a-vis, you can see here the developed as well as emerging markets. It has been there even in the recent recovery. India recovered from 15,191 to 17,956. and it was almost 18% of upside. But if you see the developed and other nations, they were lower actually than that, though they also performed, but India was one of the prime indices actually, Nifty, Sensex, which actually performed really well. If you see these outflows from the FIIs in calendar year 2022, it used to be $29 billion. It has reduced because now we have seen $6.5 billion of inflow. So it is reduced to almost $22.5 billion. So that is what happening here. And this is where actually we believe that whenever this breakout is going to come, it should come actually for the positive of Nifty, and it should be there on the higher side. If you see the commodities, they have come down. Aluminium, copper, iron ore, steel, all of them, they declined, and they are still persisting, though there is some recovery possible in, to some extent in some of them very recently, but still 30% of decline is still 25-30% of decline is there in these commodities, is still persisting. Iron ore prices have come down very significantly, and copper also, which was very sticky, it also declined in the later part, though there was a lot of demand actually from the power segment for copper. Aluminium, which is going to be used actually going forward in EVs and in other things, food packaging and all. So obviously demand is going to come up fundamentally. But so far, there are two things which are impacting the commodities. One is the dollar index moving up. The second is inflation fears, recession fears. And this is where they have come down. So that is one thing which can lead to the peaking out of inflation in US. I think that is very important with this discussion, because if you see US inflation, some sign of peaking out is still not a convincing sign, but some sign is definitely there, because there are other data points along with the commodity decline. One is the US wage inflation, which declined from 4% to 3.5%. And why the wage inflation has declined? Because there is more participation coming from the people. Previously, the citizens of US or other people, they were not coming for the jobs. There was high wage inflation, but now they are coming back, and that is the reason actually the wage inflation has declined by almost 0.5%. The used car prices also have been tapering off in US because the semiconductor availability has increased. Relatively, it has increased. China is also opening up broadly. There may be some shutdowns over there, lockdowns over there, but it is broadly opening up. PMI services has gone beyond 55 for China, and that is the reason last year the used car prices were higher. So on a base effect of higher base effect, we are seeing that this particular data point is peaking out, and this is leading to possibly some sort of peak out of the US inflation also. Now, when we talk about the participation of the people in US, there is another data point which is helpful. We used to see the unemployment rate in US, which obviously has come down to the almost 15 years, 10 years levels. But it is very important to notice the unfilled vacancies, because when people were not coming for jobs, the unfilled vacancies had moved up very fast. Now they are tapering off. If you see here, now they are coming down, because that is indicating that more people are coming for jobs now in US. So it's a good point from the inflation, lowering perspective, because the wage inflation can further come down. So as per the US Fed governors, December 2022, the broad expectation is 3.5% of interest rate in US. Now, right now it is 2.5%. So that means another 1% of increase is possible, and you have 3 meetings left: September, November, and December. So now we have to see if in the cumulative 3 meetings, if the interest rate ends up in 1% or lower, I don't think market will take it to negative now. And that is the reason that this range bound bias at a little higher levels has started. Bond yields had already moved to 3.5% in US. They declined, but again, they have moved up, but still they are lower than that particular critical level. India inflation has also started coming down after reaching to almost 8% levels. If you see here, it is declining. The food inflation is also declining. Food inflation and fuel inflation, they have 50%, actually more than 50% in India CPI. The palm oil prices have corrected significantly. And the vegetable prices also have cooled off because the monsoon has been good. So overall, it looks like, as per RBI forecast, by financial year 23 ending, we may be lower than 6%, which is comforting actually from the target point of view of RBI. Now, this is very important to see that generally people talk about 1970s scenario when the market had high inflation. Now it is 40-year high inflation we talk about. So what happened before 40 years? This was a scenario when inflation was higher. When inflation was higher, markets returns were muted. But one important point is when the inflation peaked out initially, that was a time when equity markets also peaked out. And that happened in 1974 itself. Inflation started moving from 72. It peaked out in 74 early part. And that is where the equity markets also bottomed out. I'm not saying we may have the same replica of this, but at least we should get the understanding that inflation topping out has a lot of importance in equity bottoming out. And see what happened actually afterwards. Inflation cooled off, equity markets moved up, and then inflation again moved up in the later part of that particular decade. But equity markets did not decline to the same level. They actually remained more sideways and then again moved up. So that means the initial impact of inflation, like in US, it is 9% or 8.5%. That is much higher than in the later part if it again starts moving up. That is very important point to note, because this is where our investment goes in the market. When I look at the yield curve now, because generally people talk about the yield curve inversion in US, and yield curve inversion is a lead indicator of recession. Historically, this is what is seen. So that is possible that these economies can go into some period of slowdown, some part of recession, but we need to look at some data points which are very important here. There was a 40 bips of difference between the 1 year and the 10-year US bond yields. And this declined to 20 bips of difference when Powell, because there were two statements from Powell, the US Fed governor. The initial statement before the Jackson Hole meeting was they will look at the data points and then they will act. So that was a little dovish kind of statement, which led to 20 bips of decline in that particular difference. But in the Jackson Hole, again, the outcome was little more hawkish. So bond yields moved up, but ultimately you look at the difference between 1 year and 10 year, we saw that it moved up hardly by 4 bips, from 20 bips only to 24 bips. That was another reason to justify that in the coming 3 meetings, because there is always already an expectation of 1% hike by the US Fed. The market is not taking that kind of negative, especially the equity markets. You look at the yield spread now. So in US, obviously, this yield spread was negative because the near-term bond yields were higher than a longer-term bond yields. But in China, it has not been the case. And both the economies are witnessing some kind of slowdown, but not China. Still, the short-term yields are lower than the long-term, and the yield spread is still positive. So it is possible China, because their slowdown is their own induced. It is possible towards the end of the year, there may be some demand which can come from the China also. It is not the case of yield inversion actually here. Now, euro weakness is driving dollar high. That is continued. Euro is still weak. There was one rate hike which happened by ECB, though the inflation has moved up very significantly over there. And that shows, nervousness in the economy. Europe is getting a little weaker actually right now. And that has led to, because euro has almost 60% weight in dollar index. So when this currency declines, this particular currency moves up. So dollar gets strengthened. And when dollar gets strengthened, our currency gets weaker. So USD INR gets weaker actually when this kind of equation happens. That is what we are seeing right now. Our currency is slowly moving above 79 because euro is declining actually, and it has declined from 1.25 to almost 0.99 against the dollar. So it has come actually at discount to dollar from a much higher premium. So that is a sign of weakness in euro that is impacting our currency also now. Dollar, very important data point here. After every 20 years, we have seen the surge in dollar. It happened in 82 when dollar made a top around 160. It happened in 2002 when dollar made a top around 120. And now again, it is happening in 2022. Now we have to see where ultimately the top is, made by the dollar. And till that is not happening, some kind of risk of sentiment will continue in the markets. That is exactly what we are seeing. Markets move up and again selling pressure comes, and ultimately they are ending up in a range bound session. More time correction continues. From the domestic front, there are definitely, some data points which are looking positive, because NPAs in the banking system have declined. Previously on a 100 lakh crore base, it used to be 11.5%. Now on a base of 123 lakh crores, it is 5.9%. So obviously the quantum has reduced significantly. From the NPS perspective, the credit growth, which was very low actually last year, it has moved up. In fact, it was 5% last year. Now it has come closer to 15%, the recent data. So that is a good sign. And credit growth is improving from both retail as well as industrial segments. Retail is growing actually in some banks, has seen 18-19% of growth also. Industrial component is also growing by 10-12%. So that means some capex cycle has also started. So we have already seen capex, coming from metals, cement, chemicals, real estate. So these kind of industries have already announced the capex. Metals have announced in cumulative 1 lakh crore of capex so far. Cement also, after Adani entry, we have seen there is a rapid increase of capacity additions, which is keeping the stock prices also lower because the demand is not growing that much what the capacity is increasing. Chemical space, recently SRF has announced a very aggressive capex. Looking forward, the kind of growth is there in the specialty chemical business. And then in the real estate also, because housing capex continues, there are record registrations which are happening, and that is leading to actually ultimately the credit growth in the banks. So banks earnings are growing, have continued to grow, and that is where banks look good. And few banks are definitely going to outperform now the larger banks, the index. And if you see the kind of leeway is there now, because our banking system credit to GDP is still around 57%, but in US it is almost 161%, quite high. So there is a lot of room actually when the manufacturing and activity picks up in India, that our banking system credit also start growing over the period. Now coming to the 8 core industries data. So this is one of the highest jump we have seen in the last many years in the 8 core industry. This is despite the macro headwinds that we are observing on the global front. I understand this. It will not be a consistent move. There may be few months where actually you will see the decline because the export part in India is getting impacted because of the slowdown in the developed nations. And that is the reason markets will not find a one-way move now immediately. It will spend more time, and that is where stock-specific moves will keep on coming. So you can look here. It is a data actually of June-July period where coal, crude oil, natural gas, refinery products, fertilizer, steel, cement, electricity, all these 8 core industries, they have seen one of the largest jump. Though recently we have seen again there is a slowdown, there is again a trade deficit because of the lower exports. But my sense is that it's a structural move which is coming in India. There may be some exceptions in between in few months, but eventually it will take out, and that will lead to higher growth in the industries actually. Monsoon overall in India is fine, though there was a deficit of 7-8% in June, but then thereafter it picked up. The reservoir levels actually picked up in almost all the zones, and it remained above 8% actually since then. So this is a very heartening point from the monsoon perspective. There may still be, in some areas like northern part, northeast, northwest, some part it is still lacking. And that is the reason, some crops like rice, paddy, the crop, was lower. So, but broadly, it looks like the things are better. And I think when the inflation was higher, the rural segment was finding it tough. We heard a lot of down trading happening by the rural area. So my sense is there is going to be some relief actually to that segment. And we are also moving into the festival season. If you see the recent domestic data points, some of them are showing a lot of encouragement. For example, the toy imports in India is down by 70% and exports rather has picked up by 61%. India defense exports now is one of the record of 13,000 crores. When this government came in 2014-15, it was just 2,000 crores. Now it has gone to 13,000 crores actually, the export. It's a very, very important point, because if the exports are improving, whether it is improving to Philippines or South Asian nations, or in some parts to US also, so it is a sign of recognition actually of the Indian manufacturing. And in such a sensitive category of defense, if that is picking up, I think there is a lot of room ahead actually, because of the geopolitical tensions, whatever we are seeing for the defense space in India, even on the local procurement basis also. Corporate credit growth obviously has hit 7-8 years highs now. Manufacturing PMI in India is above 56. It is in expansion mode, continues to remain in expansion mode, along with services. Services also is above 55. Power consumption has grown actually in the month of July, and that is the continuous feature that power consumption in India has continued to remain higher. That has led to higher coal demand also, and that will lead to higher gas demand also going forward. Northwest, Northeast India lag in good, rains. That is what we discussed. And I think overall basis, it looks like a better monsoon now. Trade deficit was seen. And as I discussed that we will see few months where the trade deficit will come higher because of the lesser export actually outside. But the positive is that crude oil prices are also declining. Brent oil has declined to $94. Though that means, the import bill also will be lower. So that will give some cushion actually to the trade deficit numbers. Auto sales show positive trends in July 2022. And this is continued because June we saw the recovery, July we saw the recovery. So this is a positive trend from the auto sales perspective. Mahindra Scorpio, if you see the last, when the booking started, it was huge actually, because 30 minutes we saw 1 lakh bookings and it continued. So there is one segment of SUV which is growing very fast. There were, a lot of bookings where 1 lakh, one year of delay was there, but still the bookings were there. So there is a visibility of earnings now to those companies. So it may not be a perfect rural segment, but it is an urban or luxury segment actually, which is looking at. And I think that segment is growing faster. If you see MSCI India weight increase, now we have already seen from 8%, it has increased to 12%. And there is a higher likelihood that going forward, the weight of India in MSCI can increase further to 15%. Now, why the weight from 8 to 12 increased? Because India clearly outperformed the emerging markets by almost a difference of 30%. Because of Russia and China, they declined by 15%, we increased by 15%, and then Russia also went out from the emerging market bucket. And actually that has led to 12% of move, but that is also possible. Few more percentage points, the weight is going to increase. Now, why it may happen? Because FTSE previously has already moved South Korea from emerging market to developed market. If that step is taken by MSCI, I think this is very much possible. Second, SDFC Bank merger with SDFC Limited, that will also lead to the inclusion of SDFC Bank in the MSCI bucket. That will also lead to higher inflows. And then RBI talks, can increase, because that is still a talk. We are not very sure. The FDI limit of 100% in the banking system, I think it will take time. But these things actually eventually will lead to higher weight of our Nifty actually in MSCI. So lastly, I think festival cheers for Indian corporates, because lower crude prices we have clearly seen, and there is going to be higher discretionary spend going forward. We have seen that the PMI services has gone above 55. Another important point is, if you see the RBI survey, they generally do a consumer confidence survey. Consumer confidence survey was 100 actually pre-pandemic. It declined to 50 and now it is 76. So that means the consumer confidence is still lower than the pre-pandemic, and there is still headroom actually for it to grow. And with the festival season, we can expand, we can expect that some kind of more expenditure is going to happen now, which will benefit the consumer discretionary companies. For example, auto companies, it is going to benefit. Consumer companies, it is going to benefit. It can lead to more registrations of houses, which is already there in some of the states, and obviously it will lead to better building materials cycle also. So these are all the sectors which will remain in the limelight, I think, going forward. Dollar surge is still a problem to the emerging markets. Risk of sentiment still continues because of the slowdown scenario prevailing in the developed markets. And that is where actually the markets are not able to move beyond a point. And that is leading to more range bound markets. Now, particularly from the Indian perspective, we still have 18% of volatility. And I think this particular volatility range is better to go short in the OTM options. And this is what the option writers can do. When it goes to 14%, a very low volatility, then the option premiums are very low. When it goes to 24, 25%, the movement in the market is very sharp. That also keeps the option writers away. But I think around these volatility levels, it's a better scenario actually for the markets and for the option writers to do it actually in the OTM options. And that will lead to, range bound markets going ahead. So I think November, you have US Senate elections. Before that, the crude prices have already come down, which was a problem to US also. So that may lead to some recovery in the equity markets in US also, comforting the Indians or emerging markets. So that is all from our side actually today. And this is what we believe going forward for the September month. Thank you very much.